Right. So, ladies and gentlemen, you are welcome to part two of complex group. So, in this part two of the complex group, we are going to actually solve practical problems. All right. So, this is the question that we have. It says that the draft financial statement of financial position of OmI PLC, Rural Limited, and Millie Limited, as at November, is given as follows. So, we have our NCA aspects, including the investments in the respective subsidiaries. So we see the investment here in rural, we see investment here in Millie. Then rural 2 has an investment here. All right, so rural 2 has an investment in Millie. So we will draw a group structure to find out how this one will look like. Then we have inventories, trade receivables, cash and cash equivalents. We have total current assets. We have the equity component. All right, then we have the non-current liability and also the liabilities. And we have additional information. The additional information here says that OmI PLC acquired 80% of the ordinary shares of RUA on 31st December, on December 1, 2017, when the retained earnings was what? 400 million. Of course, I think we have millions here. So I'll be mentioning the figures without them. So we have 400. Then the fair value of the net asset of RUA Limited was 2840. That is that. Okay, so that tells you that that is the fair value of the net asset at the time of acquisition. And it says that any fair value adjustment related to the net current asset, and then this net current asset has been realized by November 30th, 2020. All right, there has been no new issue of shares in the group since the current group structure was created. All right. Note 2. In Note 2, we are told that OmI PLC and Rural PLC had acquired their holdings in Millie Limited on the same date as part of an attempt to mask a true ownership on Millie Limited. OmI PLC acquired 40%, Rural acquired 25% of the ordinary share capital of Millie on December 1, 2018. Now, it goes on to say that the retained earnings of Millie on that date is 200, and those of Rural on that date is 600 million. All right, so that is that. And it says that there is no revaluation surplus in the books of Millie on December 1, 2018. The fair value of the net asset of Millie as at December 2018 were not materially different from the carrying amount. Okay, so there's no PPE adjustment kind of. That's basically what it is. It says that Note 3 says that the group operates in an information technology sector and has incurred a significant amount of expenditure on development of various internet products. These costs were formerly written off to the P&L, but then reinstated when related internet products were brought into commercial use. If you know your IAS 38, you know that this thing is not allowed. The moment you classify the thing as expense, you can no longer reclassify it as what? A development. All right. So that is that. That's IAS 38. So it says that the reinstated costs are shown in the development inventory, which shouldn't be. So it means that whatever that inventory is, we need to take it out. It says that the cost does not meet, so it's helping you more. The cost does not meet the criteria of IAS 38 intangible asset for classification as intangibles, and it is unlikely that the net cash inflow from these products will be in excess of the development cost. Okay, so this one too is another thing under IAS 38. If you watch my video on IAS 38, you understand what something we call PIRATE means, the acronym for capitalization. So the E in the last word in PIRATE is that the thing is expected to be beneficial, and by that we mean that the benefit you get must exceed the cost. I mean, this one is technically telling us that it doesn't exceed the cost. In the current year, RUA has included 80 million of these costs in inventory, of which 20 million relates to expenditure on products written off in the prior period. So this one that they are telling us It's something we should deal away with. As simple as that. The 80 should be off. It should be off. And if we were doing P&L in this question, 20 will be for against last year, then the remaining 60 will be for the current year. All right, so that is that. But let's see, are we supposed to prepare a P&L? If not, if it is not a P&L, then if it is balance sheet, we take cumulative figures. All right. It says that the commercial sale of this product has commenced during the current period. The accountant now wishes to ensure that the financial statements comply with IFRS as regard this matter. All right. It says that IV says that Rua had purchased a significant amount of new internet equipment during the year. The cost before the trade discount of this equipment is 200 million. So that's the cost before. And it says that the trade discount is 24 million. Was taken to income statement. If you know your IAS 16 well, you also know that trade discount is subtracted from the cost. It is not a cash discount for it to be taken to the P&L. All right, so that is that. Depreciation is charged on straight line over the 6 years. So technically, if you look at this, that means that they did the depreciation on it instead of doing this one minus the trade discount before doing the depreciation. So we will correct these things. All right. Now it says that the policy of the group states that PPE is depreciated at historical cost. And the group changed from the revaluation model to the cost model. All right. That is on PPE, IAS 16 on PPE for the year ended 31st December 2020. And all of its assets, they restated it to historical cost, except the property, plant, and equipment of Millie, which had been revalued by the directors of Millie as at December 1st, 2019. They said that the value were incorporated in the financial record, creating a revaluation surplus of 280. So do you have a revaluation surplus of 280 in Millie? All right, so this is it. Okay, so that is that. Now the group wants historical cost. They don't want revaluation. So it means we need to clear that thing off. All right. So this one says that the property, plant, and equipment originally cost 1,002 or 1.2 million, whichever way you pronounce it. 1,000. So this one is like trillion, right? Yeah, 1.2 trillion. The assets are depreciated over 6 years on straight line basis, and the group does not make transfer from reserve to retained earnings. So it means that basically this is what we call uniform accounting policy adjustment. All right. So we will deal with that. Okay. So that is that. If you want to know more about the uniform accounting policy adjustment, you still have to go back to my beginning video on group accounting, the very first lecture, group accounting 1. Then we learned the adjustment in group accounting 2, purchase consideration, group accounting 3, the other adjustment, the fair value adjustment. So watch the basic videos, all right? So that we will deal with that. And so this one says that they don't make transfer in respect of excess depreciation, charge on revalued property, plant, and equipment. And it says that there were no addition or disposal of PP of Millie for the 2 years, all right, ending in November. And this one says that it is the policy of the group to value NCI at acquisition at proportionate share. So this one means we are not using fair value. We are using proportionate. All right. And during the year, Omni decided to do a defined benefit plan, pension scheme to its employees and contributed to a tune of 400,000. All right. And the following, this is the figures that we have. So this one too is IAS 19. It says that the only entry in the financial statement that have been done in respect of this thing is cash contribution, which was included in the receivables. Do we do cash contribution in receivables? No. So IAS 19 is contribution. It factors into our remeasurement component, all right? So that one too, if you want more of it, just visit my video on IAS 19. You'll get the understanding. All right, so that is that. And this one says that the directors has been uncertain on how to deal with the above pension plan because of the significance in the potential increase in the charge to statement profit a statement of profit or loss relating to the pension scheme, they wish to recognize immediately any actual gains in the P&L. We have been asked to prepare consolidated statement of financial position for the year ended. So this is our reporting date, all right, in accordance with IFRS. Well, in accordance with IFRS, we know that IFRS 3 teaches us that when we are doing this, like we started this whole lecture is with, we need to do acquisition accounting. So let's do acquisition accounting as per IFRS 3. And so therefore, as IFRS 3 teaches us, what we need to do is to start with our group structure, right? So let's try and deal with our group structure. All right, so we have group structure. That will be our things one, right? We have our group structure. So let's go back, pick it, and deal with it quickly. If you look at the financial statement, we have OmI PLC, who acquired RUA. And per IFRS 3, we are supposed to talk about the percentage. And it says here that the percentage here is 80%. Which tells us that CI is 80, our NCI for this guy will be 20%. All right. That is not all. What is the date of the acquisition? They did that on December 1st, 2017. And from that date to our reporting date, which is 2020, is 3 years. All these things must be done according to IFRS 3. Then there is the purchase here again. The question said that RUA also, both of them bought into Millie at the same time. And what is that same time? Same time they bought them. Where are you? All right, they acquired. So this is the information. The same time they bought them is December 1, 2018. So from that period to our reporting date is also 2 years. Now, RUA bought how many shares in Millie? So here we are told that RUA acquired 25. All right, so percentage 25. But not only that, the parent himself also bought, this man also bought into this one of how many percentage? 40%. So that is where our D shape comes from. So you see, it's like this and the D shape. All right, so this one is a D shape. All right, so now what do we do? Effective CI and effective NCI. All right, so our effective CI, we have 80% multiplying 25%. All right, then the direct one he bought himself, which is what? 40%. So that is that. So that is what we do. And what would that give us? So if I take my calculator, 0.8 multiplied by 0.25, all right, that gives me 20%, and plus this 40% gives me 60%. So that tells me that my NCI between OmI and Millie will be what? 40%. So that is what I have. All right, so basically that is that. That's all. Then we come to our workings two. These are two subsidiaries. And so we need to do for the two. So we have fair value of net assets of RUA. So let's do RUA first. All right. Then when we are done, we will come and do the second one again. So fair value of net assets of that one will be Millie. Okay, so what do? We do at acquisition, at reporting, then what? Post acquisition. Okay, so that is that. And so the formula we use here is what? E is equal to A minus L. Don't forget everything we are doing is in millions, okay? So please Don't forget that. So we start going to go and visit the E aspect of RUA. This is the E, equity. So this is it. So what do we have? We have stated capital, which is equity share capital. Our focus is on RUA, which we have 2,000, which is always unchanged. All right. What else do we have? Share premium. The share premium is 400, and that one to 400. Nothing is said about that. All right. Okay. So that is that. What else do we have? After that, for him, there is no revaluation reserve. So straight away, we go to retained earnings. Retained earnings at reporting is 800. So we put in the 800. But what is the one at acquisition? You are told that when they acquired 80% of the shares, they had a retained earnings of 400. So that is what we have. So we have retained earnings of 400. And we are told that the fair value of the net asset of RUA is, okay, so we are giving fair value of net asset of RUA at their acquisition date. We have been given a figure. So we have what? 2840. It has been given to us. All right. So we go on. Here we have what? 400. That's the change. Okay. And they said that any fair value adjustment related to is related to what we call it, the current asset, which was realized by the end of the year. So that is that. So it means that there is a fair value adjustment, because if you add this, you are having 2,800. There is a 40 that is a fair value adjustment. So fair value adjustment, and they said that it is net current asset, and that is 40. But subsequently, we are told that at the reporting date, it was realized, it was sold. So you can choose to put 0 here, but like I have taught you procedurally, so you do fair value adjustment, this net current asset realized, and it is realized at reporting date. So here will be like this. All right. So this is what we have. Now, like I always tell you, anything that is concerning the subsidiary is dealt in workings 2. Then anything that is concerning the parent is dealt with group, that is workings 5. So we are coming to further read a note. If there is anything that concerns the subsidiary, we will deal with it in that subsidiary. So this one is RUA. Let's see if there is any other additional information that concerns RUA that either affect the acquisition date or the reporting date. All right, so let's go ahead and read. So right from here, they said that Omni and RUA, this one is for acquisition and group structure. We've done that. Then it says that the group operates this. All right. So we are told that it's a development expenditure of various internet, and these costs were formally written off and restated. All right, related to when they brought it into commercialization. Now we are told that they reinstated it. It is here. We are told the reinstatement. All right. Who is calling at this time? Just a second. So, all right. So all this story that as we read, we have the cost, and this one is about RUA, who has inculcated this thing in his inventory. All right, development inventory. Now, we all know that since it didn't meet the requirement, we need to take it out of our retained earnings. So what do we do? The 80 must go. So what do we do? You need to take away this 80. All right, so development inventory. $80, and it must go. One is 40, this one is 8, and it must go. All right, so basically that is that. All right, so that is one thing about RUA we've dealt with. So that is that. Then, so the double entry, will do it inside our inventory, all right? Then what else? Another one, this one too is concerning RUA. So RUA again, this is the mistake they did, all right? So that 24 that is supposed to be deducted from the cost was treated in the income statement. So we need to add it back, all right? That thing has to be added back, all right? So we are talking about the trade discount. We need to add it back to inside our income statement because it shouldn't be there. So it went there as a credit. So what we need to do is not really like adding back. I mean, what we mean is that we need to deduct it back, sort of thing. All right. So that is that. So if this thing trade discount, they put it in the income statement, then under normal circumstance, it should be deducted from the cost of the asset. So it is a credit to the cost of the asset. So that is what they didn't do, and we are going to do. So we need to bring that figure back. So bringing it back, so will be the 24. All right, we'll bring back the 24. But the 24 should have been depreciated. It has, you see what they tell us that is 200,000. So it means that mistakenly, what they have done is that they used the 200,000 and they did the useful life of how many years? Trade line basis of 6 years. That is what they do. And if I do this 200 of 6, that gives me like 33.33. But where in actual fact, it should be 200 minus 24, which should give me one what? 200 minus 24, that is 176. All right, and if I depreciated this of 6, I would have had 29.33. So there is a difference of depreciation 4. All right, so that is that. So as for the depreciation, you see the depreciation, because they didn't do this one, they've over depreciated. So that is that. So what are we going to do? As we are going to, you see, what they put that in as a credit, all right? So inside the P&L. And we need to bring it back because it's a trade discount, it's a discount. As for discount is supposed to be a credit. So that is that. So if it is a credit to the PPE, which is a trade discount, it's a credit to the PPE, so it's the deduction. They didn't do the credit to the PPE, they did it inside the P&L. So we need to add it back. So if you are adding it back, if they did it as a credit, so if you are adding it back, it means we are going to deduct, all right? Because they did it as an income. It shouldn't be an income. We need to treat it as an expense in terms of taking it out. And so that will mean that we'll be taking out 24 from the retained earnings. But there is an excess depreciation too that has happened. This is an excess depreciation because of that, and that will be plus 4. So it means that what we will have is a negative what? 20. So please, that is that. So if you are going to do this, what you are going to do is that this one, you are going to reduce it by 24 over 6 years useful life. Don't forget, the 24 is a negative already. So what we will get is a negative 20. All right, negative 20. All right, so that is that. Be careful about these things. All right, so that is, we've dealt with this one. The next one is a group policy. All right, so it has nothing to do with RUA. It actually has Millie in there, so we will do it in Millie. So if that is the case, this is under exam condition. Please don't bother to do this middle one. What you need to do is to focus on the streams, the first one and the last one. So what will I have? I have 400 minus, that is like 140. That gives me 260. All right, so so we will do this one inside Millie's own because Millie 2 is a subsidiary, and these ones are for the parent. All right, so let's do the Millie quickly. All right, so just as we did this, we are going to do the same. Okay, so we have at acquisition, at reporting, then we have post acquisition. So what do we have here? We also have a share capital. So E, A, and L, right? So that is that. So E, we have 800, 800. Then we have premium, share premium. Share premium is 200, 200. All right. Then what else do we have? For him, we have revaluation reserve. But something was said about the revaluation reserve. So the revaluation reserve, and please, this is something you need to take attention to. Revaluation reserve is not an acquisition date item. Revaluation is done subsequent. So revaluation is a subsequent measurement thing. All right. So you have to bring in the revaluation, which is 280 and 280. Revaluation is not something we do at the beginning. I mean, right from the beginning of an accounting year. The asset has to go, then maybe the next beginning of the next accounting year, you can do that revaluation. But you can't start a revaluation, all right, at acquisition. If they started the revaluation at the acquisition, then they will have a fair value adjustment, then we would do, all right? So basically that is that. But this one is a revaluation. And the question told us when the revaluation was, and that is the basis for which I can say that the revaluation is at the reporting date, because the question said emphatically that this is it. Remember when we started reading the question, it said that the revaluation that has happened, this was the time it happened. Look at the time. So if you start reading from here, it tells you about it, where they are changing from revaluation to cost concept, except this, all right? Now, and which the directors had revalued on which date? Have you seen the date? It is not the acquisition date. Our acquisition date was 2018. If you check for Millie, the acquisition date of Millie was 2018. This one is done 1 year after. So you can't put it at acquisition date, all right? So that is that. Okay. So that is the issue there. And but we are told that they are moving to the cost concept. So uniform accounting policy. All right. So that is that. So what we are going to do now is to take away that revaluation, because the uniform accounting policy demands us to take it away. They want to use a cost model, not revaluation model. All right. So we must take it away. Now, assuming you put 280 here, 280 here, here will be dash. But what you should realize is that at the end of the day, it shouldn't exist, because the group doesn't want to do it. So whichever way you put it, you still have to take it away. So if you put it here, you put it here. The danger for you is that if you put it here and you don't take it off right from that place it will affect your acquisition. So if you mistakenly put it here, then it means that the uniform accounting policy must also be here. So if it was here 280, here 280, the same thing must happen. Now, since it doesn't need to exist, the same thing will also not exist. But bear in mind, these revaluations were done subsequently, all right? And they don't need to exist in our books, all right? So it must go, because the group is now going to use the revaluation concept, all right? So basically, that is that. Now, they gave us an additional information about that, where they told us that the thing was actually 1.2 and the depreciation is 6 years. Now, so therefore, we need to just work the uniform accounting policy adjustment and know what we will bring in. So what has happened is that initially they were having the thing at revaluation. Now the group wants to use the cost model. We are told that the thing as at December 1, 2018, cost how much? 1,002. So that is cost 1,002, 1,002. That is what we know. Then you depreciate it in 2018. All right, 6 years. So 1,002 over 6, that gives 200, right? So 200, 200, which makes our carrying value 1,000 and 1,000. But in the following year, which is December 1, I mean, our accounting year always starts December 1, 2019, we are told that the revalue, that's why we have the revaluation surplus. In cost model, we don't do revaluation. So this one becomes what? 1,280. This one is still 1,000. So if we are doing the depreciation for this current year from December 1 to November 2020, which is our reporting year, what will happen is that this one is now 1,280 divided by 5, but here is still our 200. If you do this one, it gives me 256. All right, which makes our carrying amount how much? So let's do that. Minus 1,280, that is 1,024, and this one is still what? 800. So that is that. So we are going to pass our double entry on this adjustment. How will we do that? There is an excess depreciation because of this. Because the group wants to use the cost, you have to use cost. And if you are changing to cost, this means there is excess depreciation of what? 56. And the carrying amount to, what do we have? So if I do minus 800, that is 224. So it means that whilst we are taking away, these are the double entries, we will debit our revaluation surplus. It will go out by a debit, which is 280. Then we are going to credit what? The retained earnings of the subsidiary. We are going to credit it. All right. So that is that. If you are crediting, it's not a deduction. You are adding in retained earnings. So that is 56. Then the corresponding credit to our PPE. So this is PPE, this is retained earnings, and this is what? Revaluation. So that will be 224. So that is how our double entry will be. All right. So it means there is an excess depreciation. They've over depreciated. So we need to add back. So that is that. So there is excess depreciation on the uniform accounting that they want to do, and that is 56. All right. So that is that. So that is what we catered for. So the next thing after that was our retained earnings, right? So we have retained earnings. Now the retained earnings at the time of acquisition, we are told that the retained earnings at the time of acquisition in Millie, retained earnings is what? 200. So we have retained earnings 200. But at reporting, how much do we have there? Our reporting is what? 240. So 240. All right. So here should be what? 40. Okay, so that is what we have. So if we close out now, here is 1,002. Like I said, I'm not really interested in the middle one. I know that one here is 96. All right, but if you want, you can just do 1,296. That's all. All right, and this one you can just add it up and put it there. All right, so that is that. So that is our workings 2. All right, now let's go to our workings 3, which is goodwill. Goodwill. So workings 3, we have goodwill. Don't forget the subsidiaries are 2, so goodwill 2 should be done for them. So here we have Rua, then we have what? Millie. So we start with our purchase consideration. All right, consideration. And in this question, we are lucky that it is given. There are 5 ways the examiner can test you about the consideration. They are all in my earlier videos. Just pay attention to those ones. And here we are told that only buying Rua, the consideration is what? We have 4,920. Then Omni buying, what do we call it? Millie directly. Oh, okay. I think I've made a mistake. So let me clear it up. It's actually the PP that I copied. So this one is 2,560. Then Omni buying Millie. Omni buying Millie is what? 620. So there is a direct by the parent, we call it direct, which is what? 640. Then indirectly, Rua bought Millie. And as you know, because Omni 2 is under, Omni also has Rua, the indirect will be the percentage. And the percentage is 80% of what S used to buy SS. Check it in the part 1 video. So how much did he use? 400. So that is that. So we will do 0.8 of 400, and that gives me 320. The remaining 20% will be done in NCI. We will take it off. All right. So that is the purchase consideration that we have. All right. So what do we do? NCI at acquisition. And in this question, we all know it's proportionate. So here the NCI is 20, right? And here the NCI was what? 40, if you remember. The effective NCI that we did, it was 40. This is it. All right. So that is that. So let's go back. So here we have 20% proportionate. So what do we have in our workings too? 2840. So let's do that. 2840. Then here proportionate 40%. Let me change the ink for this side. So let me point the 0.2 multiplied by 2840. That is 568. And here it is 40% of 1002. This 1002. Okay. So 0.4 by 1002. That gives me 480. All right. Then I now less what? Fair value of net assets of Rua. So that net asset was this 2840, and this side is what? 1002. As in why we do this, I've explained all of them in the basic videos. All right. So that is that. Okay. So basically that is that. There's no goodwill, impairment, or anything. All right. So in this question, so straight away, let's find our goodwill. So this side, I have 640 plus 320 plus 480 minus 1002. That gives me 240. And this side too, I have 2560 plus 568 minus 2840. Right, that gives me 288. So my combined goodwill is given by plus 240. That gives me 528. So immediately I do this, then it means that I must start preparing my balance sheet immediately. All right. So once you get to this point, don't waste any more time. Go and do your balance sheet. So we have, this question is Omni Group. So we have statement of financial position. As at 31st, that's 30th November 2020. All right. So nicely underline it, then put your currency sign. We are doing in millions. All right. So we have goodwill, and it is from workings 3. Show it and write your 528. All right. So that is that, 528. Okay. So that is that. Then start, copying and pasting the other ones. So we have PPE. All right. So PPE, we have 4920 plus 2020 plus 1024. Keep it there because there are some adjustments. The investments you did in the purchase consideration, it will all cancel themselves out. So they don't need to repeat it. If they don't cancel themselves out, you see, all right, you see if there is any other, because this one is the investment, particularly in this one. So there is no need for you to stay there for long. So you just do inventory. The inventories, we have 1002 plus 540 plus 260. All right. Of course, there was an inventory thing that we had to deduct, if you remember. So if you look here, if you just go back and look here in your workings tool, this one is in the NCA, PPE is plus 40 minus 40. It cancels itself out. Then the inventory is 80. Then another PPE of 20. So we need to deal with that one, those ones. So you can do that immediately. You can just do that. So there is a minus 20 from workings 2. There's a minus 80 also from workings 2. Then this one that we did, have you seen this? You've seen it, right? So there's excess depreciation, all right, that we need to take care of. All right. So now, what do we see? Where are you? 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 All right. So here, what do we have here? There is this, we've dealt with the 20, we've dealt with this. Then when it comes to this one, where was our double entry? We did this in retained earnings. What is affecting our PPE? All right, 224. So it's a credit. All right. So another one minus what? 224. All right. If there is any other, we will do. But for now, this is what we have. All right. So we have what again? Receivables. So that one to do it down. All right. The trade receivables. You have 960 plus 420 plus 196. All right. That is that. Then we have cash. Cash 2 is what? 360 plus 200 plus 320. All right. So you keep it down. All right. You leave spaces. Once you finish this, leave a space. Once you finish this, leave a space, because there can be some things probably you missed. So you need to bring back. So here we have equity. Then the equity, we start with stated capital, right? So stated capital, to share capital, here we deal with only the parents, all right? So we've used the subsidiaries on already. So here our focus will be on the parent. How much is that? 6,000. All right. Then also share premium is there. That is 1,002. Okay. There's no revaluation reserve, but the group retained earnings will come in the form of our group retained earnings. All right, which will be our workings 5. All right. Then we will total that. Then also bring in our NCI, the part that we don't own, which will come in via workings 4. All right. Then when we finish, we get the total side of the equity. Then we come to our NCL, and this one, it is together. So we just do NCL is 540 plus 100 plus 80. If there is any other thing we will do. All right. So here we also have CL of how much? 400 plus 280 plus 200. When you start doing this one, it energizes you. All right. You can even start with this even before you do you start reading your question. You can start with these things. All right. So now let's come back. We've done our goodwill. So let's do the NCI 2 and go and slot it in. So workings 4 is NCI. According to IFRS 3, it must be done. So the NCI 2, let's do Rua and Millie. All right. Okay. So what is the NCI at acquisition? We did them here. So this one is 568, and this one is what? 480. All right. So that is what we do. Then NCI share of post-ac, which of post-acquisition, which is post-acquisition profit, which here it will be 20%. What was the post-acquisition profit? This one is 96, so the other one is 260. So let's do that quickly. So 260 And here we have 40% on 96, right? That is what we had here. Okay, so that is that. So let's do that. 0.2 by 568. All right, that gives me how much? So this is it. 0.2 by 260. Sorry, 0.2 by 260. This one is 52. Then 0.4 by 96. That gives me 38.4. So that is that, 38.4. All right, so that is what we have. Okay, then is there any NCI share of impairment? No. So since there is not, then the last thing we do is that we less from this rule the NCI portion of what the NCI portion of what he used to buy the SS. All right. So remember, all these things are in video 1. So the NCI portion is 20% of what he used to buy SS. How much was that? 400. So you did the 80 there. Here is where you are doing the 20%. So 0.2 multiplied by 400, that gives me 80. So we less that. All right, we don't do these things here. All right, so let's total. There's no impairment, so let's total. All right, so this one gives me 568 plus 52 minus 80. That is 540. Then here I have 480 plus 38.4. That is like 518.4. All right. So basically that is that. So if I add, how much am I having? I have together my NCI is 1058.4. All right. So let's go to my NCI quickly. 1058.4.40. All right, so that is that. Okay. So therefore, what do we do again? Let's go and do our workings 5. All right, that is for the group. So group retained earnings. All right. So basically that is that. We start with the parent retained earnings, which is 2,500. All right. Then what do you do? CI share. These are 2 subsidiaries. So CI share of sub 1, that is rural. You have 80% of the 260. Then for Millie, it will be what? 60%. All right, of 96. Okay, so let's do that. So we have 0.8 by 260. That gives us 208. All right, then we have 0.6 by 96. That gives me 57.6. All right, so that is that. Then what else do we have? Is there any other additional information concerning the group or the parent? Yes, we did have, and that is this IAS 19. So first of all, we are told this information. You know that this information is given us at 30th November. So there is pensions carried down. I mean, there is pensions carried down. So per the information they have, we are told that they also did the payment to receivables, which shouldn't be. Which shouldn't be. We all know that it shouldn't be. So let's work those ones out. So as you know, in your IAS 19, we have net obligation, brought down, which in this question we don't have, 0. Net interest, the P&L side. So let's look at the P&L side. Net interest, the P&L side will affect your, what do we call it? Your retained earnings, all right? So net interest, How much is the net interest? The interest here is 80 minus return on assets, which is what? 40. So here we have 40. All right. So that is what happened. They have current service cost, and that was 440. Don't forget, IAS 19, this is a liability account. So in liability, we leave it open. If there is something that is an income or a gain, that is the one we will subtract, all right? So that is that. So that they said that from here, we have actual gain. So actual gain, which is the remeasurement component, all right? So the actual gain is an actual gain, and for a gain, we need to what? Subtract. All right. So that is that. And we are told that the obligation carried down, you have to find it. And that one is like the difference between these two, and it's like 20. All right. But that is a balance sheet thing. But as for the P&L or our group reserve, these are what happens. So what is the difference? So 480 minus 60, that is 420. Now, in this 420, we know that the net obligation carried down is 20, right? Net obligation carried down is 20. How did we get the 20? It is net obligation, so it's 520 minus 500, and that is 20. So part of this balance is a obligation. So how do we pass the double entry? Of course, we will transfer this one to retained earnings. All right, retained earnings, even including the actuarial. Why? Because it's a transfer, is a movement, it's a realized, all right, movement. So the double entries for this one is for us to debit retained earnings with 420. Then we know that there is a pension liability, credit pension liability, all right, with 20. And the error that they did, we are going to credit our receivable, because 4,000, the 400 must come here. It must form part of contribution. You know your IAS 19, you know contribution should be in here. All right, so that is that. So here, the receivables too, there is a mistake in the receivable that they did. They put the 400 in receivable, but that thing is not a receivable item. All right, it is part of the calculating your remeasurement component. All right, so the receivable, you need to reverse that 400. All right, so that is that. Reversing it, so reversing it will be a credit in receivable. So please don't forget that in our receivable in this balance sheet, where are you, balance sheet? We need to less a 400. So that is something we need to do. So less the 400, and that is the last adjustment, right? So if I take off the 400, it's 960 plus 420 plus 196 minus 400. And that gives me 1176. So let me change the ink. 1176. We have dealt with this one too, so we can close it out. 1002 plus 540 plus 260 minus the 80. All right, that is also 1920. Then the cash and bank, there is nothing there. So 360 plus 200 plus 320, that gives me 880. All right, so that is that. And this one too, I think we've dealt with it. So let's close this one too out. All right, so I have 4920 plus 2020 plus 1024 minus 224 minus 20. And that also gives me 7720. So let's add up everything. So 7720 plus 528, right? 528 plus 1920 plus 1176 plus 880. And that gives me 12 1,224. So that should be our balancing figure we are expecting. All right. So let's go back and finish our group retained earnings. All right. So please take note of that. Let's go back and finish that. Okay. So here we bring in it's a debit, right? So pensions. Pensions is a debit. We are debiting it with what? 420, right? Yeah, 420. So 420. All right. So what will it be? 2,500 plus 208 plus 57.6 minus 420. All right. That gives me 2,345.6. All right. So let's go and slot it in. 2,345.6 on my calculator. So this one gives me 2,345.60. 23. So if I add my total equity, I have plus 1,200 plus 6,000. All right, that gives me 9,545.60. All right, so if I add it to my NCI now, that will be plus 1058.4. All right, now gives me 10,604. All right. So the pension, we had a pension liability, which we need to bring in a 20, right? So pension liability, pension liability. So that is 20. Okay. That is a 20. So we put in here 20. And so here, what do we have? 400 plus 280 plus 800. Let's go back and confirm. So 400 is 200. So 400 plus 280 plus 200. So this thing is 200. Okay. Let's have it well. Plus 200. So if I do plus 200, what I have is also 880. All right. So that is that. That is like 1,000 to make my this thing 11,000 sort of 600. But we also have this one to deal with. All right. So that is that. So let's add those ones too. So we need to add that one. So when I add that one, this one is 720. Okay. So 720. And if I add everything up, I think I have my 12,000. 12,224. All right. So basically, this is what you do. It has balance, and that is it. All right. So, ladies and gentlemen, let's face more practical examples. So this is a D shape. All right. This is a D shape. So in my next video, what I will do is that I will take another question. Then we will look at how we solve it when there is a P&L to be done, not only balance sheet. So thank you. Watch out for part 3 of complex group. Bye-bye. Remember to like the video, subscribe to the channel, and share it to your friends. All right. This is good news. Let's share. One more time. Have a great day. Bye-bye.